Hey, how's it going? We just got the closing bell for Tuesday, September 17th. It was a pretty active day. So if we look at our S&P 500, you can see that we started up higher, but after an hour, 2 hours into the market, we really started getting this negative bias into the market and we traded down. And of course, it looks negative the entire day. But if we take it into context, you can see that we closed here yesterday. We actually gapped up quite a bit in the morning, traded a little bit higher, and then traded down just to close basically exactly where we were yesterday. So if we look on a daily chart, what we see is that we're up just 0.04%. We closed out 563.09 and yesterday's close was 562.84. So just a tad higher from yesterday. So what we were saying that today it was unlikely that we were going to get directional, unlikely that we're going to get a huge movement away from the previous day because no one wants to make big bets. No institution wants to make big bets before the FOMC announcement. And that proved to be true. We got a lot of excitement. We got a lot of volatility, which is what we expected volatility to increase into the announcement, maybe for a little bit after the announcement, and then probably die down a couple of days after the announcement, unless something really, really crazy happens, which most likely not. The Fed doesn't like to rock the boat. They like to just keep things their whole point in the markets is to calm them down, is to introduce predictability and reduce volatility. So instead of acting like Bitcoin going up and down 10, 15, 20% in a day, well, actually, Bitcoin has calmed down these days. But just a couple of years ago, we were seeing 10, 20% swings in a single day. Well, the purpose of the Fed and other institutions are to calm down that volatility. So once we get the Fed announcement, we can expect volatility to come down a little bit, but we may get some wild craziness in the meantime. So in the day or two after the Fed announcement. So we see that the high was pretty high, the low was pretty low, but in the end, our open and our close were kind of close together, and our close is just not that much higher than the previous day. So if we go back to this intraday view, the other thing that we'll notice is that if I go all the way back till yesterday and I see this is where we closed, the equivalent point is right here on the VIX. This is the VIX over here. And we closed way up here on the VIX, but we closed even on the S&P. So volatility has come in, even though we have the same close, virtually the same close as yesterday. Our volatility is quite a bit higher. It's at 17.6 versus roughly 17 yesterday. That is just showing the uncertainty that is in the market. That is also giving us a slightly bearish lean going in, but uh, you never know. You never know exactly how the market is going to react. A lot is going to depend not on the rate cut itself, but the comments that come after the rate cuts. So we'll all have to evaluate those very carefully once they come. If we look at the probabilities inside of the markets, now we're at 65% on a 50 basis point rate cut. I think a lot of people are going to be really disappointed. I just we'll just put it that way. 25 basis point, maybe, but the only reason that they would be doing that is one, slightly political, two, appease the markets. There's no reason for them to go to 50, 70, 75. They have a few more opportunities to cut this year. So, well, actually, I could just see it right here. So they still have November, they have December. So they have two more opportunities to cut this year. If they need to cut more, they can cut more. There's no reason for them to go to 50 or 75 basis points. That 75 isn't priced in, but some senators are trying to pressure the Fed into going to 75. And obviously, the market put no credence into that. So but there's no reason for the Fed to go to 50 basis points either. They have November. We have no new data. We are not going to get data for another week or two. So there's no reason for them to just jump the gun, because if they go 50 and then they have to backtrack, that is way worse than if they go 25 and have to backtrack. And they may have to backtrack. If they cut too quickly, too soon, then they'll have to backtrack and they'll have egg all over their face, just like when they kept saying that everything was transitory a few years ago, 2 years ago, I think it was. So 25 is the most likely if they do cut. I am still giving a very high probability that there's no rate cut and everyone's just shocked and surprised. Although at this point, it is so baked into the market, and it is it might be a little too destabilizing for them to not cut rates, and they'll just have to take heat for on the political side for cutting rates. Let's take a look at intraday. There was something else that I want to look at. It's elevated volatility. Oh, let's look at sectors. So I made a little Excel sheet that updates itself. And of course I can't grab it. There we go. And so the change for yesterday, this is a change from yesterday. This is change from the open. We'll look at it both ways. I just want to see what sectors got attention in the end, because during the day it was very different. When we initially went up, the sectors were very different than when we came back down. So what's really interesting to see is if the speculative sectors got hit really hard today by the end of the day. That's what I really am interested in seeing, but we may see something else as well that could be interesting. So let's start with the change from the open. So energy got a lot of attention today. Industrials, both on the open and previous close, obviously much less. So by far the bulk of the positive upside movement was in energies. These we can just say are pretty much random from on the day, although this one is fairly significant since yesterday's close. So I'll just highlight that, or maybe I'll just highlight that right there. Okay, retail, a little non-random right there. And then we've got real estate on the day. We'll look at these. We'll just look at anything that is significantly beyond random. So those are it. So real estate down, that's interest rate sensitive. So well, healthcare is not. That's interesting. So looks like people do want to put money to work. And then XLK on the day. So what that means is earlier in the day, because we didn't move that much on basically zero on SMH since yesterday, and just a little bit down on XLK since yesterday. But during the day, they came down hard. So when we saw the S&P going up initially during the first couple of hours of the market and then come down hard, these two got hit the hardest. These are the most speculative, and we're set to benefit from interest rates because yield gets compared to the performance of risky assets like XLK or relatively riskier assets like tech. So the money basically is hedging itself right here. Real estate, same thing, although it's just more of we didn't see that initial move upwards the same way we did in XLK and SMH. And then IWM is up. That's interesting because we would expect the IWM to move in the same direction as a risky asset. So it looks like we're just moving in favor of different types, and retail is up. Let's see, what did XLY go? Where's XLY? It's okay, up a little bit beyond beyond random. So retail, home builders, and energies. So energies, I would not attribute that to interest rates at all. So the ones we're looking at are home builders, retail, and these on the way up. And then XLP got hit pretty hard on the way down. So it looks like people are liking risk because on day, we are even on XLK and SMH, even though during the day we are down quite a bit, but we're even day on day. But XLP was down significantly, XLV was down significantly. So it does look like people are putting on risk. At least they are in the last 24 hours, they're putting on risk. So that does favor a expectation of a favorable reaction, which I think is overly optimistic. I think a lot of people are going to be really, really disappointed. But of course, that's why we do in this type of environment, we want to do tail risk trades. We want to just have really high reward to risk ratios and we stay neutral because there's so many different viewpoints and basically no one's going to get it 100% right. So let's also look though. So what's obviously the biggest driver is that rate decision. So what I would want to know is which ones of these sectors are the most sensitive to interest rates and which ones are kind of ambivalent. So meaning that no matter what happens with the rate decision, are there any sectors that are just kind of ignore it and just do whatever they were going to do anyways? And then what are the sectors that are going to be highly reactive to it? The ones that are highly reactive to it are great ones to look for tail risk trades in. And the ones that are going to completely ignore it, those are ones where we would want to keep our portfolio. Those are the ones that we would use to keep our portfolio neutral or balanced. So let's see what we can find out for there. So if I go in the S&P, this is the day, Wednesday was the day, but starting last week, at the beginning of last week, there was a much lower probability baked into the market of a 50 basis point rate cut. At the low, it was 13%. So we moved all the way up to 65%, and there's associated move upwards in the S&P 500 and QQQ. So what that means is at least a significant portion, maybe not 100%, but a significant portion of this move upwards is explainable by the expectation of deeper rate cuts. So if we don't get that 50 basis point rate cut, if we only get 25 or 0, then what we can expect is that this will retrace at least some. So whichever sectors were most sensitive to that increase in probability, well, if that probability collapses down to 0, then they'll be reversing themselves. So one way for me to evaluate it is which ones moved the most or more than the S&P 500 moved during this time period, and which ones moved less than the S&P 500 during this time period. So I wrote a little bit of stock fetcher code, super simple. And days since, what day was that? That was Friday, September 6th. So that was 1, 2, 3, 4, 5, 6, 7. 7 trading days ago. So make sure I wrote the correct number. I have 6 days ago. And what we want to see is the percentage change since that last Friday, September 6th, the previous last Friday. So what changed the most? What changed the least? And how is that compared to S&P 500? So our S&P 500 is almost perfectly in the middle. And what we see is that was at 4.08. So I want to see things that are significantly less than 4 or significantly higher than 4. I might as well just take the top 3 or 4. So I've got silver, SMH, XHB, XLK. Silver is probably not it. Otherwise, I would see gold up here also. So there's something going on independently inside of silver. And then we've got XLP, XLV. I'm not going to count TLT because that is directly impacted by rates. So I'm just going to put that one aside. XLE, we already kind of determined a little bit earlier that it's kind of doing its own thing, and interest rates don't really affect energy anyway. So I'm going to put XLF right here. So the XLF moved significantly less. It is interest rate sensitive though. So I'm actually going to take that off because my goal is to find things that are moving independently of interest rates and ones that are super sensitive to interest rates. So even if I say, okay, is XLF negatively impacted by rates going down? Yeah, you could say that because if my bank now is paid less interest on loans that it makes, then it makes less money. So yes, we do expect XLF to be negatively impacted, but you can see that the difference here is it's less than 2%. Whereas if I add 2% to my 4 on the S&P, then I would get 6%, and I've got plenty of sectors above 6%. Actually, all three that we picked are above 6%. XLY is almost there. So I'll just, we'll see. So now I know that XLV and XLP are probably fairly insensitive to the interest rate decision. However, if people really like what's going on in interest rates and they suddenly want to go into one of these 3 or 4 sectors, I'm going to include XLY because SMH is really part of XLK. So if money really wants to go into these 3 sectors, money is probably going to come out of these 2 sectors in order to go in there. And if money is running away from these, then either money will go into these 2 sectors or they'll leave the stock market completely. So this stands to, they're kind of opposites to each other, but this is a little less sensitive. This is a secondary effect. This is an immediate effect. So if I want to look for opportunities, tail risk opportunities, I'm looking over here, XLK, XLY, SMH, XHB. And let's see, since SMH swung the most, well, let's look at all 4 sectors. Let's take a quick look. SMH sitting right at a critical, what am I trying to say? At a critical juncture where all of these moving averages are converging. And we are below, we're still in a downtrend. If this is going to be a high, if we assume this is the high, then I have 3 points. Then I can make a downtrend, 3 lower highs. I don't have lower lows. I have 1 super low low, 1 less low. So some people would call that a triangle, and we're getting squeezed. But for now, I'll just keep it simple and just say that in general, prices are trending downwards. That's all I care about. And there is nothing in today's session that led me to believe that prices might be going higher, at least not yet. It could tomorrow after the rate cut decision, but not yet. So in general, prices are heading lower in the SMH. And we are at a pretty critical level. We're very close to that trend line, that decision point. So SMH is looking like a great candidate for a tail risk trade to the downside, but also we could look for a tail risk trade to the upside to balance that out. So it's the idea of strangles or straddles. So you don't know what direction it's going to go, so you play both sides. But in this case, I would prefer to play it to the downside. Let's look at XHB. XHB is a different story. XHB looks very, very strong, unlike SMH. So instead of playing SMH to the downside and XHB, and both to the upside and downside, I could play XHB to the upside and SMH to the downside. We know that if interest rates are favorable, if the market views the Fed action as favorable, probably both of them are going to go up fairly significantly. So they have high correlation at the moment in the market. So I can treat this one up and SMH down. And that way, if this one breaks, if it fails, if it doesn't go higher and it comes down, at least I am reasonably close to a bunch of support here. So it might get caught and might not drop too much. But if SMH drops, the only thing here is that basically the MA200. And if it gaps down below that, ooh, it could go really, really far. So that gives me a offset reward to risk ratio. If the interest rate cut or the rate cut or the Fed decision is viewed unfavorably. If the opposite happens, well, what happens with SMH? There's nothing above here. And we broke through some key levels, and suddenly there's nothing here for me to worry about except for maybe this high right here, maybe a little bit this peak right here. If I look at XHB, well, I was playing this to the upside anyway, so there's nothing, absolutely nothing to worry about here. We are already at all-time highs, so we could just keep on going, screaming higher, and then SMH will take a look at it again. Yeah, it could go screaming higher, but it's probably not going to go all the way to this all-time high. That's really high. That's really far away. So if we do get caught, maybe we'll get caught here, but for sure, this one, almost for sure, this one will get caught. So again, I have more limited upside on the SMH than I do on the XHB. So again, I have this imbalance and I have a better reward risk ratio. So I'm kind of liking that pair a lot. We will still look at the, what was it? XRT? No, XLY and XLK. XLK will look pretty much the same as SMH. Pretty much the same, a little bit stronger than SMH. And yeah, so I prefer to do SMH in this case. And then let's look at XRT. No, wrong one. What was it? XLY. XLY looking great, looking very similar to XHB, but not quite as strong. So I might as well look at the weaker one out of SMH and XLK, and the stronger one out of XLY and XHB. So we're going to pick SMH and XHB. See how we can develop a pair. I'm not sure if this is going to help me because I can only look at one asset at a time. Oh, it's okay. We'll look at XHB. And remember, our rate decisions don't come generally until 2 p.m. Eastern. So let's just make sure that we do have time still tomorrow to trade. Yeah, 2 p.m. Eastern. So we still have a few hours in the morning to trade. So we could get into a position. So XHB. The other thing is if we want to do a tail risk trade, we want to give ourselves a true tail risk trade would probably just be out to 20th. Do I want to do that? Or do I want to do something more balanced? Since I'm doing a pair, I'll probably want to do something balanced. If I was only going to do singles, then I would go to the 20th. So let's do something a little bit more balanced. Let's go to, why is there only November 1st on XHB? That's interesting. Huh, we don't have a monthly in November. That's highly unusual. Okay, well, I guess I'll pick October then, because December is a little too far out. Although we could, because then we would cover an additional 2 rate cuts. Let me see. What was the December rate cut decision? 18th. So December 20th. So we would cover both rate cut decisions, but in that case, we'd probably want to go all the way out to January. You know what? Let's do Let's do insurance. Let's do insurance type. So let's go all the way out to January. So we have, if we do this, then we have, if we go, we can find a cheap way to buy insurance for this rate cut, the next two rate cut, and the elections. I kind of like that. Let's look at SMH. So if I want insurance to the downside on SMH, and I'll buy insurance to the upside on XHB. Okay, so let's take a look at SMH. We'll look at puts. And so a good place, if I want cheaper insurance, I could just buy the current level, but that would get expensive all the way out to January. So I really only want this to be a tail risk trade, meaning that if it hits, I win big, but if it doesn't hit, I lose very small. So let's say if we drop below the MA200, that's at 220. So if it just drops all the way down to the MA200, I don't care. That I would be my loss. I would just, because my insurance would never hit, and I just take that loss. Okay. So let's go to 220. So if I buy 220, and then what would be a crazy move on the SMH? So what if we go below this low, 200? So let's insure ourselves all the way to 200. Let's see what that would cost us. Oops. Nope, that's correct. $5.78. Let's call it $6. And my maximum profit potential is if this goes to 20. So that would be 15 or $14. 6 to 14, which is a little over 200. Say 233%. Is that enough? What if we go sell? We would go 195 instead of 200. I'm going to buy the 220, sell the 195. That cost me $680, but my maximum profit, if we drop all the way down to 195, that would be $18.20. That's closer to a triple. I don't like that as much. Well, let's go with the original idea. Buy that, sell that. Let's put that into option strat. Yeah, this is SMH. Out to January. And buying the 220, selling the 200. So I will save that as hedge to end of year. And then let's do the same thing for XHB, but to the upside. XHB, where is my chart? Okay. Let's do 125. So if we gap up beyond 125, this is where this will kick in. Hmm. Do I want to leave that gap? Let's take a look. Let's price it out first and see what happens. So we'll buy 125 and what would be a crazy place for it to go? Okay, so 135. Let's go say if it in a single day it moves, say 3 ATRs. So that would be, what is 2.74 times 3? 825. So 130. Okay, we'll see. I don't know if that's going to be enough of a spread, but we'll try it. So $2 on $5. So I could lose $2. I can make $3. That's only 50%, under 50%. No, 50%. 1.5 to 1. Well, 1.5 to 1. So let's try out to 40. 140. So that's $4.50 off of 10, 15, 15. Okay. So that would be a 3 to 1, similar to the other side. I kind of like that. So we'll do this. Now, remember, these are insurance policies. So basically, we would want to have real positions that profit in between because we don't get that insurance unless this thing starts to trade above 125. So if it doesn't, if it just makes a normal move and then retraces, then that insurance isn't going to kick in. But we have all the way till the middle of January. Actually, that's pretty good insurance. I like that. And then if we look at SMH, it only kicks in if we go below that MA 200. So we don't make anything on that insurance if we just stay over here and we bounce off. So their insurance policies we want to have, we're not expecting to make money on these trades. These are just there to profit on really weird outsized moves, which we do have the potential for. But again, we have this all the way out to January of next year. So there's plenty of time. And when we take a look in that context, it doesn't look so pie in the sky anymore. This are the chances of us breaking below 220 by January of 2025. That's not impossible. So it's not as crazy. These aren't like super insurance policies. If I wanted to make it a pure insurance play where I profit from extreme moves and I get an extreme amount, then what we would do is we would just make these strikes closer. That 125 would be closer to 140, so I could move it to 130 or 135. And on the SMH, then that 220 would be closer to the 240 level. So I'll just show you real fast. So if I move this to 135, okay, it's on 86 cents versus $4.14. Okay, so that's almost a 5 to 1. And then the SMH would be a better example. If I do SMH, if I do instead of 220, I bought the 205. Okay, that's $1.18 on the same five or so, $3.82. So that's almost a triple, not quite a triple. So that's, or we could push it further out. We say, hey, we don't want the buy side to start until 205, and instead of making this 200, I could make this all the way down to maybe 180. And now I have over a 5 to 1. So that would be a pure insurance play. So we're doing actually a hybrid. What I just showed you is a hybrid. And let's take a look at this SMH. we have the 220, 222, 200, 220. Did I already save this? I can't remember what I did. I'm just getting too caught up in these trades. Yeah, we already did the SMH, so we'll enter the XHB. And we'll put this at 125 and sell the 140. Is that what we decided on? Maybe 140. Nope, definitely wasn't 140. I think we just did it. Well, I don't remember. Sorry. We'll just do 130 here. We'll just keep it conservative. I think we did do 140, but I don't remember it being this expensive. Oh, this is credit. I got it backwards. Ah, that's why. No? Bear. Oh, it's not supposed to be bear put spread. Bull call spread on XHB to generate 125 to 140. There we go. That looks better. I'll save that trade to insurance to end of year. So hopefully you're learning more. We did spreads this time instead of single options. Sometimes the best trades are a little bit more complicated. So I'll probably start talking about more complicated trades, not just singles. Going forward, I'll talk about butterflies, which are excellent, verticals, condors, all sorts of different calendars, all sorts of different things. So we'll start expanding the realm of different types of trades that we'll give as examples. So we'll see. Just buckle your seatbelts because it's probably going to get pretty volatile tomorrow. And don't make any major decisions because whatever decision you make, it could be completely eradicated by the end of the day. So really, you just only really want high reward to risk ratio trades or these type of insurance or tail risk trades inside your portfolio, at least through the end of tomorrow. Have a wonderful rest of your day, and I will see you guys tomorrow.